record. Okay, I guess that means it's official. So now I can stop the share and I will spotlight myself, and then I'm going to spotlight you, Tim. And then I'm going to also spotlight our special guest, Mr. Louie. Okay, welcome. What is today? Today is Thursday, June 17, and this is the weekly briefing. This is a time of the week where we get together with the community of owners of creative firms to talk about what's going on in the industry, to share latest news, discuss trends, that kind of thing. And today, Tim, we're pretty fortunate to have a guest returning who was with us back in PPP forgiveness.
Yeah, Louie was our PPP hero. Like, we couldn't have got through PPP without Louie navigating us through all those questions we had. So
I think the rules changed 100 times since I was on.
Yeah.
I know this is going to be definitely a discussion in like the financial ingredient, because it's going to be like accounting and CPA and taxes, but maybe some operations issues as well. Louie, I'm going to let you and Tim mostly run the conversation, but would you do us a favor for anyone here that doesn't know you? Can you introduce yourself?
Yeah, and thanks again for having me. So my name is Louie Colasurdo. I'm a tax senior manager. I work at DeLapp CPA. We are a medium to large size CPA firm in Lake Oswego, Oregon, which is just outside of Portland. My experience and my kind of niche is in the technology, software, professional service, and then creative. So creative, can be any sort of thing from producers to animation to marketing firms to anything that falls under there. I've known Tim and Joel here for a couple of years, so I'm blessed and thankful for you guys having me back.
Yeah. I'm just wondering how much of that creative firm has grown since the creative segment has grown since you and I started working together, because doing quarterly tax prep over the last couple of weeks, I think every other call you were on the call with me. So it was great.
Yeah, you're stuck with me.
Yeah, I mean, for sure.
Definitely as I expand the relationship with you and RevThink, and then also just as the industry itself has gone so much more remote. It's not the emphasis on having your CPA in your state. That importance really isn't as heavy anymore, because CPAs we can practice all over the country, and firms like our size, we have the experience and knowledge to work in all sorts of states. So really having someone located within your state, while it's definitely nice, I can understand the importance of that, being able to meet physically there. It's not necessarily as important anymore.
Yeah, I'll say the tipping point for me in the relationship we have, and I want everyone to have with their CPA, is, we have certain systems and routines to kind of look at our finances, manage our projects, anticipate revenue, that kind of stuff. And for a good half of, RevThink history, I always felt like I was battling the CPA. I was trying to explain to him how we really work. When a client dumps a bunch of cash on the production company at the end of the year, or the production company was hitting these big major tax burdens. So this jump from a cash basis to accrual basis, all these really more complicated things. And I kept running against walls of somebody that wasn't kind of listening to the advice or the desire. And to collaborate with you, to be out in front of it, even to have quarterly meetings with a CPA. I don't think people are familiar with that kind of routine. There's a lot of benefit in that relationship. As we can see, like, and why I want to put you on camera is like, you can talk to your CPA. They're normal people. They can kind of think and act and strategize with you. So I love that part. All right. So I'm going to just kind of say what kind of kicked me off for this conversation specifically. It feels like, as we all can know, like the economy is changing. Gas is $4 a gallon. A loaf of bread is $20 a loaf. Like there's things out there that are completely changing in our economy. I think some of that's related to, the employment status, trying to bring on new people. That is kind of asking people for premier salaries, and that always creates an inflation. The housing market has completely changed, and can't figure out what's the logic behind that, but that seems to be growing. But also the federal government dumping a bunch of cash into the economy and then keeping federal interest rates low. We're definitely going into a place where cash management and the implications of that are going to kind of pop up for people. And what's interesting is like, I think that at this point I would want to say to somebody like, cash isn't the answer, even though we know the way the federal government handles these issues is they slow down cash, so credits can be harder to get a hold of. Don't hold on to it. But there's also tax implications of like, if you hold on to it now, you're going to have to pay greater taxes instead of investing that money forward. So just from your expertise, what are you kind of seeing in the economy and just overall thought of like position where people are going, and, just say, I know you can't give exact advice to people, but maybe it's just some global advice or things to look at.
Yeah. I mean, I would say at this point in time, the kind of view that I'm seeing is it seems definitely in the Northwest, and obviously our clients are all over the country, but it definitely seems like the economy is opening more up, especially in the kind of the creative and the animation part. Like people are getting much more busy. They're starting to come into a lot more cash. As you said, Tim, right now, cash is still really cheap. It seems like PE firms and people who are looking to investing, they have a lot of money that they're trying to park place just because cash is so cheap right now. And then I think, as how that goes with taxes, it's just, it's always really important to just be having the conversation, make sure you're being transparent and being able to project out your cash flow. So while it's great to know how much cash you have and how you're going to spend it, but you need to know, how much cash you're going to need in the future for tax payments, and also how that applies to what tax credits you can utilize there, right? You got to make sure you're aware of the things like the tax credits we're going to talk about today. And, there's a plethora of other ones that are out there that you just need to make sure you're aware of and having the conversation so it's another mechanism to help manage your cash. You can reduce your tax expense. It's more cash you can invest in your company.
Yeah. Which, again, like, I don't think people are as familiar with having a relationship with the CPA that they are actually strategizing and collaborating with some of those guidelines. Can you save me taxes, or can you fund me some special tax credits is one thing, but to be looking forward ahead and recognizing, hey, you're going to have some obligations in the future. Tell me what your revenue looks like, what your expenses look like. And I know I've been on phone calls with you recently where we're even talking about, our employment strategy. Who are we thinking about bringing on board? What is their title? How much should we pay them? We can get kind of nitty gritty in some of those conversations. And that's an important part of the planning relationship and how we're wired to make sure it works out well.
Yeah.
I had a request a few weeks ago about these tax credits that are available for different creative firms. I know that you and I worked with a firm that's in Georgia getting tax credits for, so state by state there are credits. There's R&D credits. And then even more recently, there's employee tax credits. Hey, Lou, I think somebody's audio is coming here.
Not me, but someone's having a rock party.
Yeah, no doubt. So can you give us just an oversight of like, how would we find any of those tax credits in our areas, and what's the process of getting that analysis done?
Yeah, so I mean, it really depends on the tax credits. So like you said, there's a bunch of federal level tax credits, then every state offers something slightly different. The federal level credits that we often see for creative companies, the R&D one is popular, especially if you have any sort of technology person on your staff where you're contracting out to UI or UX people, or you're developing your own, film equipment process. And then at a state level, you really just have to look at each individual state and work with your CPA and just identify what things you're aware of. Your CPA should be able to, identify, knowing what industry you're in, what type of things are available to you, especially, film. Almost every state has some sort of film production or animation type credit. So just knowing those are out there and having the conversation with your CPA to explore whether you're eligible, and then just the feasibility. Sometimes the cost of determining the credit and gathering documentation for a $3,000 to $5,000 credit really isn't worth your time after you consider the professional fees. So it's also always important to kind of get a sense of the feasibility. You don't want to go down the road and then, get a bill from your attorney or CPA for $10,000 when the credit's only gonna be $1,000 or $2,000.
So what's the question I would ask my CPA about, am I eligible, or like, what do I need to know before I ask the question? What questions are going to be asked of me, and how do I start that conversation?
Yeah. I would just flat out and start and ask them, what federal or state tax credits do you feel are available to me? Because if they haven't thought about it before, then now they're going to think about it because they need to come back with an answer for you. And then otherwise, if they do know, they're gonna have it available for you. Because a lot of times, right, you just need to have the conversation. if the CPA isn't proactive in developing these things for you, sometimes you just have to have the conversation to get the conversation going, to get the thoughts flowing.
And if they don't know, replace them.
Yeah, maybe it's time to find someone a little more at your industry level.
Yeah, what I would love people to know is that I think from a professional service point of view, there's a lot of opportunity in having a working relationship. A lot of people, when they start their CPA firms, they're busy. So they try to simplify your problem so they can get past all of it. And so they might have the intention, even the knowledge, but they're not pursuing that with you because they have a stack of papers, especially if you wait till the last minute during tax season. It's just not the right time to begin that conversation. So, I mean, the next question for you is like, when is the right time to start doing this? Because I know that if you're not thinking about it in June, you're probably not going to have the paperwork together by December, and you're not going to receive the taxes, their credit next year when you file. And that feels like it's really far away, but those timelines shrink, don't they?
Yeah, for sure. And you don't want to save these conversations towards year-end planning. I mean, I prefer to be proactive and have these conversations throughout the year, like, within quarterly check-ins, but definitely Q1, Q2, you want to start identifying what things are going to be available to you for that tax year. One, so you can start putting in the process operationally to identify what expenses, might qualify. And two, just so the CPA is prepared and has available on their side to start, claiming the credits and make sure we have everything ready so you can timely file your tax return. But definitely,
sometimes
I avoid Q3 and Q4 just because, I mean, it couldn't hurt to have the conversation late on, but definitely earlier the better.
Yeah. And, if there's research that needs to be done or bringing in a firm from a different state to help you or whatever that kind of stuff is, the more time you have, the better. And you can have those conversations slower. It doesn't have to be like a panic conversation if you do it up front. Okay. So we just finished Q1. We're going into Q2. What's quarterly two tax advice that you have? Like when you're talking to a company and you're looking at their quarterly two review, what kind of things do you discern and want to strategize around and give insight for so they can finish their year end well?
Yeah. So part of it is the tax credits like we're talking about. Two, I would say, is cash flow planning, just so we're getting a sense of how much cash you have, how much you think you're gonna have at the end of the year, how much you need to earmark for taxes. And alongside that just comes with having the conversation with how you think the year is gonna go on. And then a lot of times we have the conversation about, what CapEx expenditures, do you need or could you have? We don't necessarily recommend you buy equipment just to buy it, but if you anticipate needing equipment and you're having a good year, maybe this is a good time to buy some new computers, to buy some new cameras, have to start thinking about what stuff you might want to place in service by the end of the year so you can get, the tax benefits.
Cool. Ira, I see that you're here. If you want to jump in and ask your question, Ira's brought up the question that I think I originally reached out to you with Louie and said, would you join us on this call? And it was asking a question about specifically the employment tax credits that are happening. And it seemed like it was an offset for PPP financing. So if you didn't get PPP, you can use those. And Ira, you see your microphone's off. Do you want to ask your question directly?
It's on now, right?
Yeah, you're good. I can hear you.
Okay, great. Hey, Louie. So yeah, my question is about the employee retention credit. I know that the guidance on it has changed a couple of times, but as far as I know now, if you have gotten a PPP, you still can get the ERC. My question is more specific to people in the production community, which a lot of us are. Obviously, I know that the ERC, apparently you can qualify in two ways. One is if your income is below, I think, 50% or something like that compared to a quarter of the year before. But there's another way to qualify, and that is whether you had experienced a partial shutdown. I believe it says like a governmental body needs to have kind of shut you down. And in production, it's we all, I think, I don't know, in LA at least, I heard like production was down 75% last year. However, production was also deemed essential. So it seems a bit of a murky area to me. It's like, can you qualify for that in that second way? And if so, how? I'm just curious how you interpret it.
Yeah. So I guess on your very first part, you're correct. Now you can claim the PPP and the ERC, as we'll call it, the employee retention credit. The only thing I would note on that is you just can't use the same amount of funds for both. So you almost kind of have to think about you earmark dollar for dollar when you're paying someone's wages. How much of those wages did you use for the PPP and how much are you can use for the ERC?
Mhm.
And then, so the eligibility, you're right. There's two main ways. One of them is pretty clear cut. It's a significant decline in gross receipts. If it's for 2020, it has to be a 50% decline when compared to 2019. Or if you're claiming it for 2020, it has to be a 20% decline when compared to 2019. And then the last one, which you're alluding to, is the very gray one. So they say you have to either have a full or partial closure due to a governmental order. And that's right. And that's where it's gray. Like you're saying, it's something you have to self-substantiate. You have to self-verify that due to the governmental order, your business was forced to, materially shut down or partially suspend the operations or reduce your hours. For most companies that are essential, it's really hard to prove this because, right, you were an essential business. Your business was allowed to stay open. For most, there wasn't a cut back on the hours you're allowed to operate.
Right. So you're saying it would be best to have to prove that you actually were shut down by the government, and because we were not, and instead called essential, you don't think we would qualify for the ERC under that second way you can qualify?
Yeah, it's much harder. I think if you can't substantiate that your business was partially or fully shut down, then you can't claim that second eligibility reason because if you were deemed essential, then you generally aren't shut down.
Okay.
It's an Ira. I'm guessing you're mostly focused on something like live action shooting, where you couldn't be in the same, like a location shooting company that really depends on showing up somewhere with gear, having the person in front of you, doing something like that, opposed to an animation design company that just had to move their computers and could keep up and go and functioning, right?
That's correct. Yeah. I mean, and while we were deemed essential, like, for various reasons, whether it's like networks saying we don't want to expose our talent doesn't want to come to stage, they're afraid. We don't want to expose ourselves to insurance issues. For many reasons, production, even though we were essential, nobody wanted to shoot in person. So I'm just wondering if there's a way to kind of get around the fact that, it was, we were deemed essential because production was so far down.
Yeah. So Louie, why don't you tell us what the process would be like? So to apply for the ERC and to, I don't know, whatever, is there a write-up you have to do to explain that? Or do you just put it down on the tax form and then if asked in the future, you have to explain yourself?
Yeah, the latter. So it's not like the PPP, right? The PPP, you had to submit an application, and then when you submitted for forgiveness, you had to provide all these numbers and prove the amount that you spend on payroll and all that. To claim the ERC, you just claim it. I mean, there's 3 different ways to claim it, but one way or another, it's going to get claimed on your quarterly payroll tax return. And then you just claim it right there. You don't provide any sort of support for the decline in gross receipts or provide support for saying that you were partially shut down. You just claim it on your payroll tax return. Obviously, you want to have some sort of documentation or some sort of proof that if you were to get audited in the future and they want you to prove why you qualify for the ERC, you have to come up with something.
Okay. And then if at that point they don't approve you, they ask you the question and they don't think you have enough reason, they just basically say, well, you owe us the credit back, and you pay the balance at that point.
Yeah, they would correct your payroll tax return and take away the credit that was given to you, and then you have to pay it back plus interest and penalties.
I'd be curious if I'm always curious, like when the penalties add up. If you're, if it's a gray area and you try and then it doesn't work, then is there leniency when it comes to the penalty side? I kind of get you owe it, but what's the other side? And that's always like a personal judgment on the person auditing you, right?
Yeah, it definitely depends on, anytime you get audited, it really depends on the agent you get, but I'd be surprised, right, with all these things due to COVID, the intent of it is to provide support for businesses during a pandemic. It would seem pretty cruel to then use this as an opportunity to go after and audit people, but the IRS doesn't always make sense with what they're doing.
Yeah. I don't know, Louie. Politics always seems to make sense to me. I don't really get yeah, I think that they're right. It seems like, I mean, as you almost joked at the beginning of, like, since we had you on with the PPP, the rules changed 10 times since you gave us the first round of advice, and it seems to still be changing. I do have a question. I have a client that, his first round of PPP, his loan has been moved from company to company to company and still hasn't filed for forgiveness. And he feels like he's running up against a deadline, but the banks, this, trickle down of his application being going from American Express to some bank to some fulfillment company, whatever. What's going to happen if the bank doesn't get their act together and get his application in time?
Yeah, I mean, I've seen this. The hard thing is a lot of these banks are outsourcing the underwriting and the verification process to who knows what company, and these people don't really know what's going on. They're just they're just temporary workers that are essentially working from checklists and flow charts. So I can't say what would happen if they never get it. I mean, I would just keep pushing hard to get, to connect someone to have it forgiven, or at least get your application gone through. I mean, I've had multiple clients where you ultimately just need to try and create an appointment with a manager, a branch manager, or someone who will walk through it with you in person. So that way you have a personal connection with them and you know that it's going through the next step. You definitely want to get it, as far as you can before the due date happens. Luckily, they extended the due date out pretty far, but still.
Can you go around the bank? Can you just send an application into the SBA and say, hey, here's my application for forgiveness. My bank is jerking me around, and it's only 3 or 4 questions. Like, I feel like my kid could fill out my PPP forgiveness form.
Yeah. I believe technically you're supposed to go to the bank because the loan is from your bank. It's just backed by the SBA. So I believe in almost every case you have to go to the bank first.
Okay. Yeah, it's so frustrating because there's like this unneeded stress, I guess, that you're always just waiting for that email to come in before you go through that application process. And you feel like you're at someone else's whim to determine should I do it or not. When it comes to the PPP forgiveness, that money is absolutely, it's just a total credit to us now, right? It's not being taxed as income. There's no holdout or whatever. So if someone took that PPP money, hypothetically put it into a savings account and they got forgiven, that money is free and clear. They could repurpose it back in the company, take it out, whatever they need to with it, right?
Yep. Yeah, correct. I mean, so they did change the rules a bunch of times, but now essentially the forgiveness is tax-free and the expenses are deductible. For a while, they said that the forgiveness was tax-free, but your expenses were non-deductible, which in other words just makes it taxable. But yeah, now it's free and clear money. So you can, I mean, right, technically when you got it, you're supposed to use it on payroll, but right, it's not like a dollar for dollar tracing. So if you have funds left over, you can invest it in your business. That it brings up an interesting point with the ERC that I would mention is the ERC it's essentially taxable. It's not like the PPP. And by that, I mean, when you file your tax return for the year that you claim the ERC or the year it relates to, you have to reduce your wages that you use to claim the ERC. So your deduction, right, for wage expense will go down by the credit that you receive. So in other words, it becomes taxable.
Sure. So it basically goes from employee or payroll tax rates to, I don't know what it'd be, distribution rates, something like that. But it is still a gain, right, intercompany. So that's when you said you should analyze to see if it's even worth it. You might be dealing with a couple of $1,000s of credit and a lot of professional service fees to make very little money difference. Because if it's taxable one way or the other, it might not be that great of a difference.
Yeah, I mean, as long as you have somewhat a decent amount of wage expense, it's generally always going to be in your favor unless you're just getting charged extraordinary rates to claim this credit. But the credit's a dollar for dollar reduction of your tax, so it's real money coming back to you versus the increase to your tax return is only an increase at whatever tax rate you're at.
Tax rate.
So you're getting the difference there it still should be a favorable return.
Cool. Yeah.
Would it be beneficial to kind of walk through how the credit works and how you claim it?
Yeah, sure.
Okay.
Do you need to share screen to do that, or?
No, I think we can just talk through it. I think
Sure.
I just want to make sure people kind of understand of how it works mechanically, and then just make sure you're aware of it so you can have these conversations with your CPA and your payroll provider. I mean, cool. Ultimately, your payroll provider is going to be the one who has to report this credit for you. Some CPAs might be doing your payroll for you, but you can have your CPA help you, determine whether you're eligible and then come up with the credit.
And then you just inform your payroll provider, I want to do this credit, and then they make the modifications to each payroll. Okay.
Yeah. So your payroll provider is going to be the one that claims the credit. I mean, and maybe you're using QuickBooks Payroll or Gusto or something, but unless your CPA does your payroll, they're not going to be the one claiming the credit.
Okay.
Yeah, so the eligibility, like we talked about, the main eligibility that we'll see people get is the decline in gross receipts. So there's credits available for 2020 and 2021. So if you didn't claim it for 2020, you can go back and amend your payroll tax returns and get the credit. And then right now it's available.
And that's the 50%. If it's a 50% change from 2019 to 2020, then you would qualify for it in 2020. Okay.
Yep. And then if you qualify for it at Q4 of 2020, you automatically qualify for Q1 of 2021.
Oh, cool.
But you're right. 2021, it has to be a 20% decline compared to 2019. So you look at whatever quarter you're claiming it for and compare it to the same quarter in 2019.
2019. So it's not 2020's numbers, it's 2019 numbers for both of them. Okay. Cool.
Yep. So 2020
is that year to date. So if I'm in 2021 and I'm just looking at Q1 2019 and Q1 2021, and it's a 20% decline at that, and in that quarter, I can claim that credit.
Correct. Yep.
Excellent. Okay.
Yep. So then the amount of credit depends on what tax year you're claiming it for. 2020, it's a 50% credit based on the qualified wages paid for that quarter. And then in 2021, it's a 70% credit for the wages paid for that quarter. And you're limited to 10 grand per employee per quarter. So in other words, a $7,000 credit per employee per quarter. So if you pay 3 employees 10 grand each for the quarter, that's 3 $7,000 credits or $21,000 that you'd get back. So
that seems like a pretty good credit.
It could add up. It could add up fairly quickly.
Yeah.
And it gets applied. It's applied against the employer portion of Social Security. So 6.2% that's paid anytime you pay your employee. It comes out of the company's pocket. It's employer bared expense.
Okay. How does it work on a accrual company or a cash company? How does that work? You just compare it. If you're accrual in one quarter in 2019 and accrual in 2021, that you're going to just use that basis, or cash in 2019, you'd use a cash basis in 2021.
You use however you're reporting your payroll tax returns,
okay,
which are generally on a cash basis.
Okay.
Yeah, so you want to look at your payroll reports, and like Gusto and QuickBooks, they can all run like payroll reports for a quarter, so you can see how much you're paying people.
Great. And
then for the qualified wages, they're essentially just gross wages you pay people. The only thing you can add to it is healthcare expenses. And it's really intended to only be for full-time employees, which is anyone who works more than 30 hours a week or 130 hours a month. The one very gray point with qualified wages right now is owner wages. So S Corps and C Corps, most professionals believe that those wages cannot be included in the ERC calculation. So if you're 100% owned S Corp and you pay yourself wages, most people believe you cannot include those wages in the calculation. The IRS hasn't specifically said that, but they've said that anyone directly or indirectly related to the owner can't be included. So they're pretty much alluding to the owners can't be included.
Yeah, right.
But it's pretty gray.
So you can't hire your wife in order to get the credit, is what they're saying in there, but they don't say the owner themselves.
Right. But almost everyone believes that you can't do that.
Sure. I like how that is. Almost everyone believes. It's like it's not black and white.
No, no. God forbid they give clear guidance. So then there's 3 main ways to claim the credit. If you were going to claim for 2020, you have to go back and amend your payroll tax returns. If you're going to claim it for 2021, if you've already filed your payroll tax return, you have to amend it. You can simply reduce your payroll deposits in real time. So determine what your credit's going to be, and then just reduce the amount of Social Security that you're depositing as the employer portion when you run payroll. That part that would be kind of hard to do unless you're really in sync with your payroll provider. If you use QuickBooks or something, that would be really hard to do. And then the last one is you can actually get an advance of the money for 2021. So you can file this form 7200, and you can get the money before you actually file your payroll tax return. It takes between days and weeks. So you can get the money much faster, and then you just reconcile the amount on your payroll tax return. But you have to file that before your payroll tax return actually gets filed. So there's a couple different ways you can get it.
Yeah, that's cool. I didn't know you could get it ahead of time. That seems to be like a little bit of a cash push for you. And I'd say, we're going Q1's already finished, so it's not too late to kind of reconcile and look at Q1, and we're about ready to finish Q2. So this might be a good chance to start that conversation.
Yeah.
Ira, I hope that helps. It sounds like you're going to take some discernment. I see that Colin put out there that his tax team advised him to not to advise against going on the ERC or using the ERC. So
Yeah, I mean,
might be just on a case-by-case basis is to figure some of this out.
it's helpful. I mean, my CPA was investigating further, but from her team, she was saying that they were thinking that we could file for it. And we're collecting kind of like information for how to support that. But basically, my other question is regarding the, you just mentioned the fact that you can get an advance in 2021. What if you use an outside payroll company who's filing your 941s? Is there still a way to do that?
Yeah, when you mean outside payroll company, do you mean like you use a PEO, or you just mean like you use another company to run your payroll and file your payroll tax returns?
What does a PEO stand for?
Professional employment organization. Essentially means you're just outsourcing your employees, like your employees become
Yes.
that one.
Yeah.
Yeah, you can still claim it then. It just they take care of it on their end because your payroll gets reported under their EIN, and then there's allocation schedules that essentially gets distributed to you. So you
I
can still
thought there was an issue because that company just files like 941 for like all the companies they service, so they don't break it out, but you're saying it shouldn't be an issue?
Yeah, no, it shouldn't be a problem. It's the same thing with, because they file like an allocation schedule with it, which essentially shows all the companies that they are filing for. And with the R&D tax credit, which we mentioned before, small businesses can claim the R&D tax credit as a payroll tax credit. And you can still claim that if you use a PEO. They just allocate that credit to you.
Okay.
So when you say PEO, do you mean like Rapbook or Entertainment Partners or one of those?
Yeah,
Yeah.
that's it.
Yeah,
Oh, wow.
I'm not
I
familiar with
hadn't thought
entertainment
about
partners,
that
but I
at
know
all.
Rapbook.
I didn't realize we could use them in that way. I mean, we use them for all of our freelancer payroll, but I didn't know we could use credits there. That would be awesome.
Yeah.
So we would contact Rapbook and say, hey, we want to go for the ERC, you guys.
Yep. Yeah, exactly. Just contact them, say that you're interested in and needs, either come up with the amount of credit first or see if they have someone you can work with to come up with it.
Yeah, so Colin, it sounds like you would have to do the calculation to inform them what the credit would be or how it would work. And then they would modify it on their end while filing. So report back to you. You still have to talk to your CPA and get those numbers in first.
Yeah, we were talking about doing it with our Gusto payroll, but I hadn't even thought about the freelance payroll.
Yeah.
That'd be awesome.
Yeah, because as long as they are an employee, because you're technically still the common law employer. You are just, I almost knocked over my water. You're just technically running your payroll under their EIN.
Well, the weekly briefing paid off for someone this week. Somebody's happy we're doing this.
Yeah, it's important to just be aware of these things and then just start have the conversation. You can't, even have the conversation or try and claim these things if you don't know about them.
If Louie helped save you money this today, please send money through his Venmo account. Here, we'll give it to you right now.
My wife would see that and be gone.
$7K per employee. That's a chunk,
Yeah. He's only taking 12%, Colin. So it's a good deal. You can keep this 78% of it for yourself. Well, Louie, thank you very much. I don't want to go beyond the half hour that we do and be respectful of people's time, but maybe for some people we got into some gritty detail here, but clearly to get into that details is pretty helpful, especially in that last thing you're talking about using the professional services. I do think that a lot of people, as Colin was saying, we kind of forget that part. Like we paid it off and they're handling, it's their payroll, not ours. But to know that there's opportunity in the R&D credits as well as the ERC credits, and probably others, a good thing to explore.
Yeah, no, I'm happy to help, and thanks again for having me on. If there's any trailing questions, you can always send them to Tim, and he'll forward them on to me, and I'll try and help as best I can. Yeah,
feel free to email me questions. I can introduce you to Louie. Hit me up in community. Happy to do it. And we'll post this video in community too, Louie. So there might be other people looking for you one way or another, LinkedIn or wherever it is. I know your LinkedIn is up to date because I think we did that during the PPP, so everyone knew where to get hold of you. Awesome. All right. Thank you all again for tuning in. It was great to have you part of this, and we'll see you again next week on the weekly briefing. Joel, I know you're hanging in there. Thanks for launching this thing for me. I appreciate getting started. And Louie, we'll probably talk to you one more time before this end of the year. If you're making people money like this, we're going to keep you around.
Love it. Happy to help.
All right. Thanks you. Bye-bye, guys.